Arguably no more important question than how quickly Americans are traveling again, vacationing again. And so far, the pickup has been enough for shares of Wyndham destinations to rally big off the lows, more than double. Let's bring in the CEO who's joining us here to talk about what's happening in the space. Michael Brown, back with us on the program. Michael, great to have you here. Last we spoke was at the end of 2018 when things were heating up in this economy. So how fast are they reheating right now?
Well, the leisure demand travel is really starting to pick up. I'm not sure that leisure travel ever went away. It was just the ability to travel with 42 stay-at-home orders. Obviously, now with 50 states having reopening plans, we're seeing leisure demand really pick up in the form of bookings from July until the end of this year. So I'd expect a strong summer season moving into the fall.
Michael, your company is a little bit different from some of the traditional hotels. Wyndham Destinations spun off from the larger Wyndham business in 2018. You're mostly focused on the timeshares and partial ownership. Walk me through how that dynamic has been different from the traditional hotel market.
Well, there's some clear differentiators, and I think it really fits in well to how leisure demand will change in the fall of this year. First of all, I think you're going to see a rise in drive-to destinations, and given that 95% of our owners are within 300 miles of their nearest resort, we will see a good drive-to arrivals here the second half of this year. We expect upwards of 90%. Space. People want to travel now with the feeling of A, comfort, and B, enhanced cleaning. And a timeshare has additional space where you can prepare your meals in your room, and each of the family members have their own individual room, as well as all the amenities that great resorts provide. And I think really, especially as we mentioned, with 100% leisure traveler, we expect within travel and tourism, the leisure demand will be the first to come back, and it'll come back the strongest. And I think we're already at the front end of that trend here in June and moving through the summer season.
When you look at the way this rebound is taking shape, what to you are the big risks? Is it just government enforcement and rules? It sounds like you're of the belief that consumers are ready and they're willing. They just need the opportunity.
Well, that's right, but I think the government has laid out clear guidelines, and we're following that lead on health and safety protocols, and we're seeing that consumers actually are appreciating all the measures we've taken and how we've innovated our business. Although there's health and safety considerations, the fact that we've fundamentally changed many of our processes in this quiet period has actually enhanced our customer experience. For instance, one of the things we've changed is the entire check-in procedure, where it's now curbside and it's now at half the time, and that's good for customers. The one part that continues to remain a concern is what happens in the fall. As far as the COVID-19, we can't affect that. All we can do is our part to make sure that the spread is slowed and our customers are safe.
Right now, are there limitations defined regionally? Are there other areas that are slower, faster? How quickly can you paint with broad strokes here as a leader of a business that is, I would assume, pretty different based on each area and their reopening rules?
Well, that's absolutely correct, because we have a broad footprint of about 180 resorts in North America, and we are seeing differentiation by region and by location type. In our early openings in Florida and South Carolina, Tennessee, Missouri, we've seen the beach destinations with the strongest demand and ones that rely on amenities with slightly softer demand. And I think that'll continue through the summer season. As it relates to states, each state is in a different stage of their reopening. And when you look at states like Hawaii, They will be one of the last to open in the United States for us. We're expecting late July or August. Whereas, as I mentioned, Florida and South Carolina, we opened, those were the two first states, and we opened them May the 26th. So we'll follow the state guidelines and reopen according to their timelines.
Right now, how is all this affecting profitability? Even if there is a return to something normal, I would imagine that there is a question still of whether or not it's the same profitability and margins for normal. I know a lot of hotels have had to take certain measures to make sure their employees, you talk about safety, you've got to have different gear, all that kind of stuff. Is that going to eat into the profitability of the business?
Well, in the short term, the second quarter is clearly for the entire economy greatly impacted by the impacts of COVID-19. We actually view this as an opportunity to innovate our business. We will take on some additional costs to run our resorts, but we believe we will actually be stronger coming out of this than we were coming in. We've taken the opportunity to refine our resort operations and our sales and marketing. So our expectation is we will really be managing to a stronger bottom line. The speed of our return to where we were pre-COVID-19 will be dependent on how strong the economy returns. But in the end, no, we expect to return to where we were pre-COVID-19, just with better margins. Again, the question is timeline, depending on the strength of the recovery and what ultimately happens in the fall with COVID-19.
What about use of cash and the priorities from a capital standpoint? When you and I spoke last, you were very adamant about the importance of staying shareholder-friendly, outlays via buybacks. Is that still at the top of the priority list?
Well, if you look at our second quarter actions, you saw that we were one of the very few consumer discretionary stocks that paid a dividend. And that is a reflection of two things, really. The fact that about 50% of our EBITDA comes from recurring streams. And as we looked at the full year cash situation, we felt that we are projecting positive cash flow of the year. We suspended share buybacks. We fortified our balance sheet by drawing down $1 billion of our revolver as a precautionary measure. But in the end, we were one of the few companies that returned capital to shareholders in the form of a dividend in the second quarter. And depending on, again, the strength of the economy, our objective is to return to a more fulsome return of capital to shareholders as we see a return to normalcy in our business.
Going forward, do you expect to return to the same payout ratios that you had prior to this crisis? Because along with this crisis, there was also quite an uproar about businesses and their use of cash, as we saw government assistance come to companies that were ailing, a lot of them that had buyback programs, airlines, some of these other companies. Do you feel that that's changed the nature of what investors should expect or what CEOs should spend in terms of that ratio?
Well, as you look at our capital return, it is an approach that focused on dividends, share buybacks, and the potential for M&A or organic growth. We'll continue to evaluate all three of those as what's the best way to return capital to shareholders. We've been very transparent to the market about our leverage ratios and our intentions of returning capital. So I feel we've been an extremely responsible company pre-COVID-19, and we will continue to show that level of discipline post-COVID-19 or during the reopening. And that's one of the reasons that we suspended share repurchases in the second quarter is there's the need to fortify your balance sheet and make sure that your liquidity's there. And all of our projections show us to have a very strong cash position going back. But our priority is to the safety of our customers and returning capital to shareholders.
What about the ability to spend in this environment right now? Can you think about big growth initiatives, or do you have to try and keep the purse strings tight? Are there places that you want to build out? Are there is there real estate you want to acquire that you can right now?
Well, there's a level of priority, and we've moved a long way in 90 days. 90 days ago, when we were in March, there was just tremendous uncertainty about cash burn and reopening plans. We've now laid out a clear projection of 100 to 150 million of free cash flow for the year. We've seen our resorts reopen. We'll have 85% of them reopened by the end of June. And at that point, we will start to evaluate our ability to grow cash and look for opportunities, whether it be M&A or just individual projects, because if 08 and 09 was any indicator of what will happen now, is probably about 12 months post-reopening, you'll start to see real estate value really show up. And we want to be in a position, and that's one of the reasons we've been fortifying our balance sheet, to take advantage of real estate opportunities or even potentially M&A. But cash and liquidity remain the first priority until greater certainty it shows through in the second half of this year.
Okay, Michael Brown, good to have you back on the program. Appreciate you joining us here.
Thank you. Great to be here.
Good insight into what's happening here in the hospitality industry, from hotels to timeshares and rentals. Michael Brown, CEO at Wyndham Destinations. WYND is the ticker.